Once the auditors understand and document controls at the entity level, they then turn their attention to these individual transaction level controls. So we're going to move on to the next three steps in the process here. And recall we gave an example of one of these transaction level controls in the prior section. We're going to go through a more detailed example here looking at transaction level controls surrounding the sales function within a company, which is a very important area of inquiry for auditors. Of course, sales are an area where there could be greater incentive for management to misstate numbers because of the pressure to meet profit expectations and so forth. So this is an area of great concern for auditors. We're going to spend a lot of time in future chapters looking at the sales and revenue functions more specifically, but just for our purposes here today, I want you to get a feel for what a transactional level control looks like in some detail. So first off, we have to talk a little bit about the different documents and files that are found in the process of selling goods. So notice here we have a number of different documents that we're going to want to review as an auditor when we're looking at the sales process. First off, the customer master file is basically a list of all customers we have in our business, and it also shows the credit limits associated with those customers. The sales order basically is laying out the terms of the sale, showing what products are going to be sold, showing the different prices of the various products. And once we actually make the sale and we're getting ready to ship the products out, there's a couple additional pieces of documentation that we're going to be working with. The bill of lading typically is prepared by the transporter of the goods. Basically, it's used as verification that the goods we're actually shipping have been received by them and are in fact in transit. And the packing slip is prepared on the end of our client. They're actually putting together this slip to kind of verify that the goods that they are intending to ship are in fact being shipped. So just a double check to make sure that everything they're sending out is actually included in the shipment. The sales invoice, of course, is sent along to the customer for eventual payment. And all the information about the sale itself, the payment, the accounts receivable information, all this is going to be included in a sales cycle database. And of course, there's going to be monthly statements of receivable balances and the aging of receivables that companies are going to want to analyze when thinking through their sales process and cash collections process. So as an auditor, if you're overseeing the sales process, you want to look at all these different forms of documentation, and there's different areas within the sales process where things can go wrong. So here are some specific risks that we find within the sales function. And again, this is just one example of a transaction level control. There's numerous different types of transaction level controls we're going to look at later on. Notice in the sales process a couple areas of particular transactions we could focus on. First off, initiating credit sales. When we're making a credit sale, we want to make sure it's to a customer that's been approved and they're within their credit limit. So there could be a number of different issues with this process. So we want to make sure that good controls are in place, to ensure that the proper procedures are being followed. So notice that customer master file again. That's going to help us verify that sales are made to authorized customers. There's a risk that we might make a sale to an unauthorized customer, so we want to have a control in place to make sure that only folks that are authorized to buy stuff from us on credit actually are being able to make those purchases. In the area of delivering the goods, a number of different issues could pop up. Notice this particular one here is referring to items being shipped without the shipping documents being generated. All right, that could be problematic. We want to have that documentation in case there's any issues between us sending out our product and our customer eventually receiving it. Maybe we send out 10 units of an item. If we don't have this documentation and the customer says, hey, we only got 6 units in our shipment, well, we don't really have proof that, we actually sent the 10 out. Was it a problem in our shipping department? Was an issue with the carrier that was transporting those goods on our behalf? Without that proper documentation, it's very hard to tell where the issue arose. So we want to have proper controls in place. So proper controls to make sure that we receive a bill of lading and we produce a packing slip for every shipment that's going out the door. Now, recording sales is a big area of interest to the auditor, and notice there's numerous different situations and risks that can arise surrounding the recording of sales. Notice one of the bigger issues that you might find on an audit, a very problematic situation, is there's billing for fictitious transaction or duplicate billing. So one control we could put in place to try to prevent this from happening is having software applications that match the sales invoice information with all that underlying shipping information. So if we have 10 units of goods going out, there should be a sales invoice for 10 units being sent off to that customer. So that sales invoice is going to be kind of the document we're going to want to look at when we're trying to test that particular control. And notice that's testing the occurrence assertion on the part of management. Did this sale actually happen? All right, if we don't have a bill of lading for the goods going out and we're saying we have this sale, we're adding revenue to the books, right? We see this entry made for like $1 million sale and the auditor can't find the bill of lading. All right, that's problematic. That's a clue that maybe, in fact, the sale didn't occur to begin with. Another situation that could occur is customers may be billed incorrect amounts. So remember, we talked about in earlier chapters that the auditor will follow up with customers to verify the amounts of accounts receivable that are showing up on the balance sheet. So this monthly statement of receivable balances, it's a breakdown basically of who owes how much to the company. As an auditor, we will scan over that document and try to verify that the actual goods that have been shipped out have been billed correctly and we're not billing, or our client isn't billing incorrect amounts.